This video is part 2 of a video series about the wheel strategy. In video part 1, the demonstration of back testing the wheel strategy on the SPY in 2021. So if you want to see how well the wheel strategy can work when the market complies, definitely check out part 1, and the link to that video is in the description below. This video will look at November's price action when the price of SPY dipped below the strike price of our November cash secured put trade, and what adjustments might we make when the strike price is breached. Hey, this is Rochelle and welcome to Multiple Passive Streams of Income. Let's start off with the rules we're using for the wheel strategy. So we're trading the SPY. The trade is initiated on the first day of the monthly option at 10 a.m. We are assuming that we have $100,000 in our trading account. Again, that's not inconceivable for people with retirement accounts. And we are trading one contract for illustration, and the strike prices are chosen based on 25 delta. Now let's look at what happened in November. On November 22nd at 10 a.m., the price of SPY was $472.81. And we selected the 24 delta strike price of $458. When I used the back testing software for Thinkorswim, it's called On Demand, I didn't see a 25 delta strike price, so I used the 24 delta strike price of $458, and this created a credit of $322 because a share at that strike price was $3.22 times 100 shares. And again, we're trading one contract to do this illustration for simplicity. And to place this trade, we would have had to have $45,800 in our account. And the way that's calculated is you take the strike price of $458 and you multiply it by 100 shares, and that's how you figure out how much money you have to make the trade. On November 30th through December 6th, the SPY price dipped below our strike price of $458. Now at that time, there was a lot of bearish sentiment about the market, and it was due to the anticipation of the Fed's announcement of interest rates. The crypto market has been on a decline, and there's a lot of uncertainty about maybe Russia and the Ukraine going to war. Obviously, we're going through inflation. COVID numbers are spiking. So again, a lot of the news was bearish. So let's take scenario 1. We may not have felt bearish and believe the market will rebound, and it actually did. So the put would have probably expired worthless, and we could sell another cash secured put in December. Let's continue with the rest of the back test, having chosen not to roll our option, believing the price would rebound. So on December 20th at 10 a.m., the price of SPY was $454.11. Using the 25 delta strike price of $432, we could get a credit of $5.37 times 100 shares, so that would total a credit of $537. And we'll need $43,200 in our account to make the trade. Again, we take the strike price of $432, multiply it by 100 shares, and that's how we come up with $43,200. And since the lowest price of $437.98 did not move lower than our $432 strike price, this put expired worthless, and we can continue with another cash secured put. So let's do that. On January 24th at 10 a.m., the price of SPY is $429.09. Using the 25 delta strike price of $404, we can get a credit of $6.62 times 100 shares. So that would total a credit of $662. We'll need $40,400 in our account to make the trade, right? Again, the strike price of 404 times 100 shares totals 40,400. And as you can see, as of the end of the week, so far the trade is working well. And here's a snapshot of the trade as of today. Now, let's explore scenario number 2. Let's say we were bearish and we believe that the market may not rebound. So in that case, we would decide to make an adjustment to be safe, because we don't want the put to be exercised at 458 just in case the price of SPY drops drastically. So what can we do? So again, on December 1st at 3 p.m., the SPY price was $457.55, and it is the second consecutive day that the SPY price went below 458. We could decide to do a rollover to the January 21st option chain and roll down to give the price room to fluctuate. To do the rollover, we would buy back the 458 strike, which at that time is worth $9.28. And then we could roll out to the January 21st option and pick a strike price lower than 458 so that we can buy another cash secured put. And on the screen, you're going to see the prices of the strikes on December 1st for the January 21st option. If we follow the 25 delta rule, we would receive $7.16 for the 430 strike price. And that would concede a loss of $212, which is the difference between the bid for the 458 strike price and the bid for the 430 strike price, which is explained on the screen. We may also decide to try to break even and pick a strike price that may allow that to happen. If we go that route, it would be the strike of 441 for a credit of $10. And that's on the screen as well. And if we selected the 430 strike, the put would have expired worthless and we would again sell a cash secured put. If we selected the 441 strike on the expiration date of January 21st, the SPY price decreased lower than 441. So let's look at what that looked like. So at 2:52 p.m., the SPY price was 441.03. To buy back the 441 strike, it would have cost us $1.41. Let's say we decided to ride it out, hoping that the market will close higher than 441, and hoping if the market is going to decline, it only has a little over an hour to do so because it's the day of expiration. So let's just say we let it ride. The market eventually closed at 437.98, which is lower than the 441 strike price. So our put would have been exercised. So now, since that happened, we can take a look at the covered call process of this wheel strategy. Once we were exercised, we now own 100 shares of SPY at the 441 strike. So since the put was exercised, we now have a chance to look at the covered call process of the wheel strategy. Now we own 100 shares of SPY at 441. So on January 24th, the price of SPY is 429.09. We could do a covered call against our 100 shares of SPY, and we can get $7.74 to sell a covered call. So that gives us a total credit of $774, right? The $7.74 times 100. As of the close of February 12th, the price of SPY is $440.46, which is very close to our 441 strike price. So let's continue to follow the results of these trades in a future video. And the best way to do that is for you to subscribe and hit the notification bell. So after you subscribe, you'll be notified when I drop new videos. As we continue to look at the wheel strategy, we're going to discuss other options if the market eventually drops so drastically that rolling options are not viable anymore. Please like, dislike, would love to hear your comments. All interaction counts. As always, thanks for your time, as I know you could be any other place right now. Take care.